The phrase sell in May and go away refers to an investment strategy based on the theory that the stock market underperforms in the 6-month period between May and October compared to the other half of the year. The origin and history of the phrase can be traced back to England, where investors, aristocrats, and bankers would sell their shares in May, enjoy the summer months, and return to the market in September after a horse race called St. Leger's Day. The historical pattern was popularized by the Stock Trader's Almanac, which found that investing in stocks as represented by the Dow Jones Industrial Average from November to April and switching into fixed income the other 6 months would have produced reliable returns with reduced risk since 1950. The statistics and evidence that support or contradict the seasonal pattern vary depending on different markets and time periods. According to Fidelity Investments, since 1990, the S&P 500 index has gained an average of about 2% annually from May to October versus about 7% from November to April. An academic paper that surveyed stock markets outside the US found the same pattern, calling it remarkably robust. However, the pattern did not hold in 2020 when the S&P 500 rose 12.2% from May to October amid the COVID-19 pandemic recovery. Moreover, the pattern is likely to be outweighed by other factors such as economic cycles, earnings reports, geopolitical events, or market sentiment. The theories and explanations for why the pattern exists or doesn't exist are inconclusive. There are several possible factors that may contribute to the seasonality in stock returns, including seasonality in investment flows due to year-end bonuses, tax deadlines, or holiday spending. Additionally, agricultural cycles that affect commodity prices and inflation expectations, as well as market crashes that occurred in October, such as in 1987 and 2008, may also play a role. Lastly, behavioral biases that influence investors' mood and risk appetite could contribute to the seasonality as well. However, these factors may not be consistent or significant enough to explain the divergence between the two halves of the year. However, blindly following the seasonal investing strategy comes with drawbacks and risks. One significant risk is missing out on potential gains during the summer months, particularly if there are positive developments or trends that boost the market. Additionally, paying transaction costs and taxes that may erode the returns from switching between stocks and fixed income is another drawback. Furthermore, investors might be influenced by other factors that may override or reverse the seasonal pattern. Lastly, holding only one asset class at a time may lead to losing diversification benefits, which is yet another risk associated with following the seasonal investing strategy. There are alternatives and variations of the seasonal investing strategy that investors may consider. One such variation is rotating into less economically sensitive stocks, such as consumer staples, healthcare, or utilities, from May to October based on historical data that show these sectors tend to outperform during this period. Another alternative is investing in fixed income or cash equivalents that offer lower risk and higher yield than stocks during the summer months. Investors may also adjust the timing of buying and selling based on technical indicators or market signals. Lastly, investors could consider combining the seasonal strategy with other factors, such as value, momentum, or quality to potentially increase their returns. In conclusion, the sell in May and go away investment strategy has a long history and some statistical evidence to support it, but it is not a foolproof or consistent approach. While there may be some seasonal patterns in stock returns, other factors such as economic cycles, geopolitical events, and investor behavior may outweigh them. Blindly following the seasonal strategy may lead to missed opportunities and risks, such as transaction costs, tax implications, and loss of diversification benefits. However, there are alternative approaches that investors can consider, such as rotating into defensive sectors, investing in fixed income, or combining the seasonal strategy with other factors. Ultimately, investors should weigh the pros and cons of the seasonal investing strategy and decide based on their individual goals, risk tolerance, and market outlook.
Thanks for watching and have a nice day. Hit like, subscribe, and ring the bell for more content like this.